the world price building, of course, is one of the major ideas behind the world economy and world finance, because without them there would be no stock exchanges, there would be no possibility for countries to exchange goods and services. So world prices are very, very important for the world trade, world investment opportunities, and global trade, global tariffs, global protectionist policies, international free trade ideas. Everything started in the world economy, and the globalization actually started with world prices and the mechanisms to set those prices. Over centuries, people tried to understand how this world of prices is going to work, how to exchange goods and services with other countries, how to import and export those goods and services. So this is going to be quite an interesting thing, I believe, because discussing issues that are very primary to the world markets and the global economy is very important to understanding the structure of the world economy itself, and the international system of currencies actually that started working this way also was very, very important for the world economy and the world financial markets. So like I said, people started thinking about exchanging goods and services, and the question was how to find a sort of a instrument, a sort of an equivalent that would make it people understand how they could exchange their goods manufactured in their countries and export them to other countries and get paid for these goods and services. Of course, services started flowing around the world. This is a very modern phenomena, and there is no actually a world price for world or international services. A world price for them doesn't exist actually, because services is something immaterial. They cannot be touched, they cannot be smelled, and actually you cannot weigh them or store those services. So mainly world prices, of course, are about, in its absolute majority, they're about goods, manufactured goods, and in particular standard goods. And by standard goods I mean things such as petrol, oil, gas, gold, coffee, tea, timber, things such as these, of course. There are other types of world prices, and here we're going to speak also about indices such as Nasdaq, S&P 500, CAC, or DAX index in Germany, or CAC index in France, or Nikkei stock exchange index of Tokyo exchange, because these are also very important. They're not prices in the general sense of the word. They cannot be understood as world prices, but still they determine the global conditions, the global infrastructure, and they determine the business climate. So they also sometimes influence, they're going to influence world prices for oil and gas and coal and aluminium and other things, because there are great corporations behind them. There are many subjects and people dealing with these contracts and trying to conclude deals, foreign trade deals with other countries. Generally, how do we actually determine world prices? Theoretically speaking, world prices are determined very, very easily. They are determined by ways of, by means of a liberal modal world price building. So, for example, if you see this graph, this is the liberal modal of world price, world prices and how they are constructed. For example, there used to be times when there were not so many countries as today. Today we've got over 200 countries in the world who supply their goods to the world markets, and they're very numerous in number, these goods, millions of goods. They produce automobiles, computers, things such as these. So they're very important economic subjects in the world market. So each country has a supply and demand, and these are the phenomena which are generally known to be working in the market economy. Without demand and supply, we cannot understand the price and how it's built and how it's done. So it's very important to first start thinking in terms of that sort of material base. So each country has its own, like I said, demand and supply for a particular product. For example, country A and country B produce, let it be oil, for example. Let's try to understand and set the price for oil, how much it's going to cost. Perhaps they're going to trade, let it be the barrels of oil. A barrel of oil is a standard measure to weigh the amount of oil which is going to be priced at the world market. This is usually a 159 liter barrel of oil, and that today, for example, Brent crude is a very important benchmark for oil in the world market. It's something like $37 or $38 a barrel of oil, a barrel of oil. Later today we will be talking also about that benchmark, because it's also very important and interesting to understand how it's working and what kind of factors there are behind those things. So, like you see here in this graph, we've got a country that produces oil very expensive in price. This is country A. Country A is a very, I think this is going to be a country that is not very rich in natural resources, or maybe it is very rich in natural resources like Russia, but it is very difficult to extract oil. More difficult than it is to extract oil, for example, in the Middle East. And we've got a country B with lower costs of producing oil, and they're going to have more competitive advantages in producing this oil and selling it to the world markets. So the general idea of this liberal model is that actually we got to have a country that produces something very cheap and a country that produces the same good very expensively. And the idea of free trade means that a country A should completely abandon the production of oil and start importing it from country B. And country B, of course, is going to supply oil to the country A. The only problem is to understand how much it's going to cost on the world market of oil. Like you see here, country A has many people, many businesses, companies, or just the general public who suffer from the lack of oil. And they cannot, many of them cannot purchase oil at such a high price in country A. It's going to be very ruinous. And we got to have this sort of demand curve, unsatisfied demand, and we got to put it on the graph of the world market. We do that parallel to the demand curve in country A. And also we got to move the curve, the supply curve of oil from country B, which is very rich in oil resources, and they produce there very cheap. We also got to move that price, that demand, that supply curve onto the world market. We do that also parallel, and we've got this world price. It's somewhere about 2 money units for a barrel of oil, for example. So this is the theoretical background of how the world prices are actually built. That's going to be the amount of oil that is going to be supplied to the world market, and the country A is going to buy that amount of oil from country B. What's going to happen after this price has been set in the world markets? That means the price of oil in country A should go down, of course, because if they start importing this oil from country B, they're not going to have such an expensive oil price in their country. That means we're going to lower that price. It's going to move somewhere here. It's going to be close to 2 units of money a barrel of oil. And you see what we have. The number of people who could buy oil now is very, very large. So more people are satisfied. But the only problem about this is that many companies that produced oil before this trade liberalization, they are going to lose their market, and this profit that was previously directed to their funds, to their vaults, to their financial statements and their balance sheets, now is going to go to country B. Country B is going to be very rich, not only in oil but also in the hard currency, because world market, like we know, works in US dollar terms. Everything is being measured in US dollars, and that means each barrel of oil is going to be sold on the world market measured not in euros, not in British pounds, not in Japanese yen, but in US dollars. And this is also a very important thing that you should really understand. Also, like I said before, world prices are going to be very important for the global trade deals, because they're usually done again in US dollars, and the US dollar is responsible for 80 to 90% of world trade deals. We're going to try to understand the workings of the international gold markets and international oil market, and everywhere we will have to deal with US dollars, because that is a vehicle currency, that is a sort of a single language in the global economy that is going to work for the benefit of all countries in this world, because the United States is the greatest economy actually in the world. Although we've got problems in the United States today, they have a number of economic issues to try to solve, because well, the whole world now lives in terms of coronavirus crisis. If we start and try to understand the dynamics, some sort of dynamics in oil prices and how they developed through decades, we got to look here on this slide. We've got a US WTI futures price in constant dollar terms. WTI means West Texas Intermediate, which is another benchmark to measure oil prices. Apart from the Brent crude oil, we've got WTI. This sort of oil is being produced in the United States, in Texas, and this is also a very important material, a very important phenomena to understand. And usually WTI futures are priced a bit lower, a bit cheaper than the Brent crude, because they say that the quality of Brent oil is larger, it's greater, and maybe also there are some sort of investment issues there, because maybe it's more difficult to extract oil in the North Sea, because Brent oil is being extracted. That's a shale oil, that's not a fracking oil. Fracking oil means that it's going to be extracted from somewhere in the Texas, directly from the earth, and that's the way it's going to work. So if we look at this graph, there were a number of essential things, essential factors. When we tried to understand the workings of the liberal model, what was very obvious for us, that we did not consider any factors that could affect the demand curve or the import or export opportunities. We did not take into consideration civil wars. We did not take into consideration climate change issues. We did not think about economic crisis or other shocking situations in the world. And actually, the theoretical background of trying to understand the workings of world prices is that there are too many deviations, too many factors that are not considered, that are not taken into account. But the world prices are very, very sensitive to various global and national conflicts. Over the recent decades, starting somewhere from the 1970s, we do not have here the 1970s, but they're also very important. That decade was very important because 1973 was the year when oil prices started their shockingly expensive career, because 1973 was the year when Israel and the Arab world started their Yom Kippur War. That was the fourth Arab war in the Middle East. That war led to directly increasing world oil prices. That was a very dramatic situation. Also, OPEC countries, that is the international cartel of countries who are responsible for the world production, for the distribution of oil, and for the decision how much oil is going to be produced, including the Middle Eastern countries, mostly the Arab countries, such as Saudi Arabia, United Arab Emirates, Qatar, Bahrain. Also in South America, they've got Venezuela. In North Africa, that's going to be Algeria. Well, there are 12 countries altogether in this OPEC group, which is Organization for Petroleum Exporting Countries, and they were very important international body in the 1970s and 1980s, because they were responsible for international price spikes, international price, oil price shocks. We should understand, of course, that oil is in those decades, in the 1970s and 1980s, oil was the major petrol to drive the world transport, to drive trains, aircraft, power stations. So that was a very important resource. Nobody could get rid of oil consumption, because that was the basic good for economies. Unlike today, when more countries are going to switch to greener technologies to produce electricity out of wind and solar power or other types of resources, renewable resources. But then, back then in the 1970s, 80s, there was just no way out of that difficult situation. So countries had to continue to buy expensive oil. And so if, for example, world oil prices were priced at something like $3 to $4 a barrel in the early 1970s, the embargo that was introduced by the OPEC countries in 1973 led to an oil price rising to something like $12 and $14 a barrel. So that was the world oil prices quadrupled, and in some instances even quintified. That was a very, very difficult occasion for especially the developed countries that were not so rich in oil, in particular the Western European countries, Japan. The United States also was hit dramatically by this world oil crisis, because well, actually the United States itself is an oil manufacturing country. But unlike today, in those days, the United States consumed only half the oil they could have produced. So the other half of the oil they were importing from the Middle East, from Venezuela and other countries, from Northern African countries. And they tried to reserve their oil, tried to keep it safe for the future generations. But when Donald Trump became the US president in 2016, the first thing he did was he started stimulating the oil production in the country, and he allowed more shale oil to be produced. And the United States immediately became the world's greatest manufacturer of oil, the largest manufacturer of oil, by far outpacing the oldest rivals in these markets, Saudi Arabia and Russia. Saudi Arabia and Russia were the major countries. He exported oil and manufactured the majority of world oil in the 2 decades before Trump got elected in the United States. Unfortunately, what nobody could expect after Donald Trump did that, well, actually many companies, many transnational companies, multinationals, the largest oil companies, ExxonMobil, Chevron, British Petroleum, ConocoPhillips, and other oil majors, they immediately started investing more money into shale oil. They just went mad about investments in the oil industry, and they were happy about that because world prices were rising. But this year everything changed. Like we know, the coronavirus crisis brought oil prices down to very low margins, and oil companies suffered greatly. All countries who exported and manufactured oil suffered greatly from that sort of shock. And that was a very deep disruption in the production of oil. Like you see here, world oil prices hit an all-time high in 2008. That was a period when world oil prices went as high as $160 a barrel of oil. That was absolutely fantastic for countries such as Russia. Russia immediately accumulated huge reserves of gold and hard currency, the euro, the US dollar, and other hard currencies, mostly of course the euro and the dollar, and the gold reserves. Russian reserves went as high as $500 or even $600 billion. So $500 billion US in Russian oil reserve funds, the future generation funds, sovereign wealth funds to be called collectively. So they were just filled up to the brink. That was a very fantastic occasion and very opportune moment for Russian economy to have its global strive to the world markets. That was a period of great leap forward in terms of economic growth, when Russia grew something like 7 to 8% a year in terms of GDP. And actually we were very happy about that. People were very happy because their salaries, their wages were rising higher and higher, and well, people just admired and were trying to keep up with the global growth, which also was very, very impressive in those days. But the same year, 2008, in the United States there was a great crash, which we call today the Great Recession. That was the world financial crisis, and oil prices slumped. Of course, after that, They recovered a bit, and they even sometimes touched $100 a barrel. That was also a very good period for Russian companies and for the Middle Eastern companies. But then, due to international sanctions, due to coronavirus, we see that these factors led directly to a drop in world oil prices. And of course, like I said, oil today is not so a very important resource any longer. So more resources are going to be coming from renewable energy. More electricity is going to be produced from wind and solar power, or nuclear power, and other greener technologies. The world is very concerned about CO2 emissions, and some countries such as Germany, from Denmark, Great Britain, and other countries who signed the Paris Agreement in 2015, they set very ambitious targets to decrease the global carbon impact by 2050 down to zero. Even today, it seems really fantastic because we've got 30 more years to come to the year 2050, and we see that it is very difficult to keep with that sort of pace in carbon emissions reduction, CO2 emissions reductions, especially when we look at countries such as India or China, and the greatest CO2 emissioners in the world. The United States under Donald Trump exited this Paris Agreement, and that was a very drastic blow to international agreements, and that was also an important factor behind the world oil prices collapse, and that was also a very difficult thing. Petrol, of course, this is not actually a global good to speak of in the real sense of the world, because petrol is not, it is a byproduct, it is a finished good. Actually, when we're talking about world oil prices, we're talking only about the oil itself as a natural resource, as a standard good. Petrol is not a standard good because it varies from country to country, and of course there are some standard measures to produce petrol from oil in Europe or in the United States or in Russia. All those Euro 4, Euro 5 standards in terms of environment protection and other various important subjects. Many taxes are being added and exempt from the price of oil and the production of petrol in the country, and the consumption of petrol as well. There are, of course, transport facilities that could not work without petrol altogether, and mostly those transport facilities, we understand that aircraft and a maritime fleet cannot work without oil, actually, because today we still produce jet fuel and ocean liners fuel, which is also very diesel fuel. So this is going to be a very, very long process to get away from oil in these terms, and it's going to be very, very difficult. Like you see here on this chart, fuel is the most expensive good in countries such as Sweden, Norway, Iceland, the United Kingdom, France, Germany. These are countries with one of the highest levels in terms of petrol prices. But petrol, like I said, is not oil, and they do this also. They have very expensive petrol there because they try to limit the consumption of oil by charging high prices on consumption. Unlike countries such as Russia or Kazakhstan, Mongolia, and other nations, Brazil, they have much cheaper petrol because, these countries are very rich in natural resources, and they're not so highly developed countries. I think if we increase petrol prices in Russia, we're going to have a very, very dramatic market transitions, market situations in this country, maybe even a sort of a social unrest, because oil prices and petrol prices increases are going directly to lead to spikes in prices for the consumer goods, because to deliver those goods you got to have transport facilities, and transport again is being powered by fuel, and we cannot get away from that also. Usually, how do we understand the prices of world markets that are going to impact the global economy and the national economy? What's going to be the sort of a mechanism that is telling us that something is going to change, and if the price for oil or gold changes, then we've got some changes in the national economy and in the local markets. If you look at this slide and this sort of formula, abbreviated formula, what we have here is the mechanism how world gold prices influence economic policies, economic growth in a particular country. For example, just imagine that one country such as Russia experiences gold influx. We buy more gold comes into an economy, maybe because we started producing more gold, or maybe we sold more goods to the international markets and then exchanged US dollars into gold or something of the sort. Anyway, gold comes to the country, and what is growing with gold is the amount of money we can print. The more money there is, the higher going to be the prices. Price increases lead directly to interest rate increases. If we do have more expensive investments, more expensive capital, that means investments are going to be smaller than they were before. If we do not have more investments in the economy, then aggregate supply is going to drop, because companies are not going to invest too much into producing and expanding their production opportunities and production facilities, and so that manufacturing is going to slow down. Profit for those companies is going to go down. If companies do not get profited from manufacturing goods, they try to lay out employees. That means employment is going to contract. if we've got too many unemployed people, they do not buy goods and services. That means aggregate demand goes down as well. If more people do not buy goods and services of those companies, aggregate supply is going to go down even further. And that would lead to a drop in GDP. And finally, generally a drop in GDP, a very dramatic drop in GDP like today's, for instance, due to coronavirus crisis. This situation leads to general economic crisis, to more inflation, more unemployment, and other very drastic and dramatic situations in this country. Also, when gold comes into the country and money is being printed more in bulk and prices rise, exports of this country are going to be lower, and imports are starting growing, and that would, if we buy more imported goods for the gold or hard currency that we received from the previous years when the economy prospered, the gold is going to come out of the country, and that is going to influence in a very reverse way. That's going to be absolutely different situation. If gold goes abroad, if we use this gold to buy imports, the amount of money goes down, the money supply is contracted, prices go down together with the reduction in money supply, interest rates are going down. Lower interest rates stimulate investment opportunities, and more companies start growing. They're going to expand, try to get more profited, try to create new job opportunities, and people are going to work and start working more actively, unlike they did before. Their purchasing capacity is growing. They're consuming more and more goods and services. That would lead directly to increase in aggregate supply. And finally, global gross domestic product is going to show stable economic growth. In theory, this thing is called zero-sum game. So you never get profited from increases in gold reserves or decreases in gold reserves. This is going to be named something like zero-sum game. You benefit in no way when you try to stimulate gold influx, or the same thing would happen when gold goes out of the country. First, of course, it's going to stimulate economic activity. But later, if you do not have much gold in your reserves, that means your country is going to be unsustainable. And if something happens, for example, deep economic crisis like coronavirus crisis, you will have to supply more foreign currency in order to sustain your national currency, to balance the budget, to try to stimulate companies, not let them go bankrupt. So you will have to have some money to do that, billions of dollars. And this is what our gold reserves are supposed to be used for. And also foreign exchange reserves, they're very important things to get used to. So that sort of opportunity and that sort of situation is going to be very, very difficult to omit. It's going to be very difficult to understand the situation where prices are not very important for the economy. So they're always going to impact the global economy and the national economy, because they are very, very determined way of thinking about commercial transactions and international contracts, because nothing can go without world market prices. And like I said, we're going to have a very, very drastic economic transitions if we do not speak about world prices and the factors behind those prices. We're going now to look more closely on the world of prices, and looking at this chart here on investing.com, which presents live charts for major commodities, major currency pairs, and many other things. What we can see here, it's a very, very interesting and important and very useful tool, which shows very interesting phenomena. Why for example, oil prices changed, or why they didn't change. Looking at the very recent history, that's going to be yesterday, like you know, world markets and foreign exchange markets are working only on working days. That means they work only 5 days a week, and all national holidays and weekends are going to be without any price dynamics. So nobody is going to trade. Actually, national holidays and weekends are going to be a very good days for traders, because they get some rest. They can think about some strategies for Monday, when the market is going to open again. Today the markets are closed. Nothing is going to work. I think the only market that's really going to work is the Bitcoin market, because it's a very, very interesting and very controversial market, and it's working 24/7. It's working online, it's working on real-time basis, and it never stops. It has no interruptions, and actually people may trade there every day, every minute of the trading sessions. Computers, high-frequency trading strategies are working here also. But markets such as oil markets, natural oil markets, gas markets, they're not working. These markets are generally called CFD markets. CFD stands for contracts for demand, and they include contracts for oil, gas, palladium, gold, and other minerals. If you look at this picture on this chart on investing.com, they've got very interesting things, these sorts of points, endpoints, and these endpoints means a very important news that could affect the world oil prices. And if you see, for example, what influenced world oil prices very recently, what were the major events that influenced the world oil prices, that they moved in this way. If we start, for example, somewhere here, it was November the 5th, 2020, somewhere 2 o'clock in the afternoon, and we've got the news. We do have the news that oil prices actually changed, started to drop due to oil snap's rebound in drag to US election outcome and financial stimulus. So, on November the 5th, that is on Thursday, oil prices, after they reached, well, actually an all-time high for since the collapse in March and in April, after they reached something like $41.50 a barrel of oil, due to uncertainty in US elections results, because people and market traders are still do not know who is going to be next president of the United States, whether Donald Trump is going to be re-elected or Joe Biden is going to enter the Oval Office in the White House. So nobody knows. Actually, before that, many traders were expecting a landslide victory for Joe Biden, and they were making bets that Joe Biden is really going to become the next president of the United States. But later, people sort of got disappointed, and the markets really crashed. Many indices, world prices started going down, and oil prices were no exception to that. And due to COVID-19 outbreaks in the world, due to more lockdowns, because if we have more lockdowns, that means less people are going to travel, less transport is going to work, and that means demand for oil is going to drop, and the same happens to the price of oil. It's going to drop as well. And it started dropping from November the 5th, and it dropped down to first that was $39.76. Later it recovered a bit, but it recovered a bit because in that sort of situation in the market we call adjustment or market correction, because a world oil market, for instance, cannot drop or rise, only rise or drop or fall. That means there are always periods of increases and periods of decreases, periods of ups and periods of down. So even if oil price is going to go down due to certain circumstances, like for example COVID-19 or elections in the United States, there will always be some bounce back, and oil really bounced back. Yesterday they bounced back, and the price of oil reached again something close to where they were starting on November the 4th and 5th, actually, almost $41 a barrel. But by the end of the day, yesterday, on November the 6th, world oil prices really started contracting due to other events in elections, due to stocks retraces. Stocks retraces means that there were reports about the stocks of oil in the United States and other major economies, and when they change, that directly leads to changes in world oil prices. So they started going down again. Also, oil prices started falling again because in the European Union there were light lockdowns, like I said. People started to travel less. And now we have this. So by the end of yesterday's trading session, we have this situation, which is almost $40 a barrel, $39.70 a barrel. And what kind of strategy are we going to take? So what again the traders do on the Monday? Are they going to buy or sell Brent oil futures? First, of course, what they are doing today is they are very attentively listening to what is happening in the United States elections and the results of those elections, to what Donald Trump is saying and tweeting. Twitter, unlike other centuries and other decades and other oil shocks, Twitter today became a sort of a very important instrument and factor that influences world prices and currencies. If Donald Trump writes something, it immediately is going to affect the world dollar market, the world euro market. It's going to affect S&P 500, and it's going to affect the price of gold, the price of oil as well. If these news are not very bright for investors, they're going to sell oil and buy into gold, because gold is a safe haven for the national economy, for the investors and other traders. Also, I would like to say a couple of words about how to understand, in order to understand the workings of the international world markets and world prices, you got to closely watch what is happening across the world in terms of events. We were already speaking about COVID-19, lockdowns and light downs, lockdown light or complete lockdown. Well, actually, today the world understood that with total lockdowns we're going to break economic activity altogether, and the world will not be able to recover very quickly after events such as these. So you got to be very, very cautious with these lockdowns, and if you sustain all economic activity in a country, that would lead to more deaths and more economic disruptions and social unrest than if there were some limited policies, some limitations, restrictions, but still the economy should go working, should continue to work, especially the foods industry and other manufacturing industries. And for these industries, there's not going to be any lockdowns. They're going to be working more stable, and they're also very important indicators for other industries to listen to try to understand what they're going to do in the next couple of days and weeks and even maybe years to come. Today we expect the global economy contraction by the end of 2020. It's going to contract very dramatically. It's going to do very high swings in the globe. They're going to be very dramatic changes in the global economy. This is not going to be very, very easy for a global economy to continue its economic activities, its economic conditions. It's going to be driven by very, very specific events and situations happening in the global financial markets, the global investment opportunities markets and things such as these. So this is not going to be this is not going to come without a price. Everything is going to be changing really dramatically for these countries and for the rest of the world. The United States is going to suffer from the global collapse. The situation in the world markets is going to accumulate, and people will have more difficulties in continuing their economic and business activities. Of course, countries such as the United States and the European Union, Great Britain, Japan, they introduced many stimulus packages, miscellaneous fiscal plans to stimulate economic activity in their countries, which is also they try to escape the total collapse in economic activities across the world. They were quite successful in eliminating a total collapse in world economic activity and in world prices. For example, when the coronavirus just started in the early 2020, in the early spring this year, the Federal Reserve, the European Central Bank, the Bank of Japan, Bank of England, Reserve Bank of Australia, People's Bank of China, so they all try to stimulate economic growth in their countries, and they were quite successful doing that so far. They are, of course, sometimes they were not very successful in doing their businesses because, well, sometimes they try to stimulate their economies in ways that were not very successful, because people, due to coronavirus, people first started consuming. They were very, very cautious about consumption. They did not try to consume too much, and that is the reason why demand actually contracted too much in the world, in the rest of the world, and they had a very dramatic situation back then. Also, when we're talking about the situation on the global financial markets, dear students, are you still listening to me, to what I'm saying?
Yes, please.
Thank you very much. I'm just checking because I sometimes feel like I have some difficulties with internet connection or that sort of thing. So I just try to I'm just trying to show you what we're going to do in terms of investment opportunities and global investment opportunities in the markets and how they work. So, like I said previously, world prices are affected by various economic conditions, and economic stimulus, those huge packages that were given to by national governments across the world were very, very important economic factor behind the way the economies worked. So when we're talking about economic events, we absolutely must make sure and understand why they're so important and what are the major and important economic events in the world that affect world prices. Let's see what they are. What are those events? First of all, we try to look through economic calendar, which is always present on investing.com. You go there and choose, for example, a time interval of 1 week, for instance, from November the 1st to November the 8th until today. We cover that period, and we're going to look what are the data that were most important for global stocks, for the global markets and world prices. In order to understand what were the most, so there are a number of events. Some of them are not very important, others quite important. If you see that these news which are listed here, they have 3 stars. That's going to be an impact of a particular event. That means high volatility is expected on the markets if that sort of figure is going to be published, that sort of statistics. For example, on Monday, November the 2nd, I think that's GMT time. So in order to be able to better understand when was it specifically, we got to choose, of course, Moscow time. That's going to be GMT plus 3 plus. And that's going to change a bit. Yeah. So, for example, on November the 3rd, Australian Reserve Bank, that is the Central Bank of Australia, made another declaration, an interest rate decision about how much the interest rates is going to be, and the actual interest rate in Australia remained the same, so 1%. Yeah, they lowered actually. Yeah, you see that the previous interest rate by the Australian Reserve Bank was 0.25, and that means they decreased the interest rate down to 1 point, and that was a very important economic event for the national economy. That means that coronavirus is going to hit this economy even further, and there may be another economic collapse, and in order to stimulate the economy, they try to do this by lowering interest rates. That was on Tuesday, November the 3rd. If we look what happened on that particular day with Australian dollar, because this is the national currency of Australia, what was the impact that was left by that sort of change? You got to go again to investing.com charts and see what happened to Australian dollar currency pair. What was what does the trading say? Let's look. We got to find November 4th, like I said, when these news were when this piece of news was published. November 3rd, 6:30. November 3rd, not November 4th. So let's see what happened with Australian dollar, because like I said, interest rate decisions are very important for world prices and world markets, because they're always affecting the markets, the market situations, the market opportunities and investment opportunities. Usually when interest rates go down, that's going to lead to it's going to stimulate investors buy more dollars and sell more national currency. So if they have this in Australia, that sort of situation, with these monetary policy statements, that was on November the 6th. Actually, this is not a very convenient chart because it's a 5-minute chart, and you got to really, it's going to be really slow in understanding what was really happening back then. It's going to be really slow. So we may move to 15 minutes time frame and see what happened back then on November the 3rd. So you see this drop in Australian dollar market, that was directly caused by the announcement that came on that particular day. The Australian dollar, the people, the investors, the traders started selling Australian dollars in bulk. You can see that actually the news were not very bright for this currency, and economic activity, economic events, they affected really dramatically. So after the announcement came, Australian dollar started to go down, and people tried to buy more US dollars. Why do people buy more dollars in these circumstances? Well, because they fear that the economic situation in the country will deteriorate, and the economic growth is going to slow down. That's why we see this very high drop in the markets. Also, what we also should be very, very interested about is, of course, employment changes in a particular country. For example, yesterday in the United States, very important statistics came out. So investors and traders are interested not only in US presidential elections results, but also what's going to be about the unemployment in the United States. And you see that yesterday in the United States, the statistics said that 638,000 more people got a new job. That means unemployment actually decreased very dramatically. The prognosis was 600,000, but it was better than expected. And the market usually, due to this situation, people buy more dollars, and the world gold prices are going to drop. Usually this is what happens to gold when these statistics are published. And if we look, if we try to find gold, let's see what happened to gold yesterday when this piece of news was published. Let's see gold futures. I think that would do. Gold futures, very important market for gold. So you see these dynamics. Well, of course, world gold prices were really rising very greatly recently due to coronavirus, of course, due to global instability. Gold became a sort of a safe haven for investors because there was a panic in the markets. And let's see what actually happened to the price of gold yesterday. But you got also to keep in mind that the gold price is also affected by a sort of uncertainty today that we have in the United States with the elections results. So it's not only going to be very important in terms of what's happening with unemployment in the United States, but it is also very important what's happening actually with election results. So, like I said, you see this very, very dramatic drop in world gold prices so yesterday on November the 11th. As soon as these statistics about more jobs being created in the United States, so more jobs created in the United States leads directly to the drop in gold prices. So if gold costs something like $1,962 an ounce of gold, later it dropped down to $1,941. You see, this is a very, very great drop down. So people who anticipated such a drop in the price of gold before that could earn very much money if they sold their gold assets that they accumulated. Later, you see, by the end of the day, the price of gold recovered a bit, but still it did not reach the level it achieved a bit earlier that day. And the price of gold increased before that due to, again, election uncertainties in the United States, because, like I said before, this is a very important factor today, because nobody knows who's going to lead the United States in the next 4 years, and this is a very important economic and political event. Dear students, if you do have any questions, I am ready to answer those questions, because we've got really 5 minutes time to the end of this lecture, and maybe if you have any questions, feel free to ask them. Is there anything I can explain to you in more detail